Okay, I think we can wait just one more minute and then want to get started.
All right. We just got the CPI numbers out, so zoom in on that. Yeah, and the bond market did not like it. Oh, darn. All right.
Yeah, I'm ready.
Good morning, everyone, and welcome to NVBIA's first webinar of the year. It is the Real Estate Finance Committee's reflection on the 2022 market and to focus on what to expect in 2023. All of us are really waiting for this. We have three very informative speakers, and of course, a huge thank you to Carol O'Connell of CMG Home Loans and also the Real Estate Finance Committee's chair this year and last. She organized all of our speakers programs for today. So thank you very much, Carol. Now, I just have one plug for NVBIA. It's for an event. On Thursday, February 9th, the newly formatted presidential celebration, New Beginnings, Presidential Style, will be held from 5 to 8 p.m. at the International Country Club on Route 50. We will be installing our 2023 Board of Directors, as well as honoring members of outstanding service to NVBIA. But the best part really is that we have secured Jeff McKay, the Fairfax County Board of Supervisor Chair, as our keynote speaker. So you do not want to miss this event. Register today. Now it's time for this wonderful program. So Carol, you have the floor.
All right, thank you, Debbie. I also want to thank my committee members, Kurt Stahl, Chelsea Getz, Chelsea, and B. Gerard, who helped me put this together and invite the panelists. And we have quite a great group of people on our panel today. I'm very excited to hear their insights and expertise about the housing market and what we experienced and what we're about to face. So let me first begin by introducing the panelists. The first is Molly Boesel. Molly holds a position of principal economist in the office of the chief economist at Corelogic, where she's responsible for analyzing and forecasting housing and mortgage market trends, including the single-family rental market. She's nearly 30 years of experience and expertise in the mortgage market, analysis, model development, and risk analysis in the housing finance industry. Molly is a frequent speaker at leading industry events such as this one, and a contributor to several industry publications. Her original research blogs for the Corelogic Insight are frequently picked up in national and trade publications. and are leveraged as news pieces. Last year, Molly and her colleagues won an award for the published work on the pandemic-related housing preferences, home prices, and rent and inflation. Molly, thank you so much for joining us. It's quite an honor to have you here.
Thank you.
You're welcome. Our second panelist is David Logan. David is a repeat panelist for us, so we thank you for returning and helping us. He is a senior economist and director of Director of Tax and Trade Policy Analysis at the National Association of Home Builders. Prior to joining NAHB, David served as the chief economist for the U.S. House of Representatives Ways and Means Committee. He was the senior economist for the U.S. Congress Joint Economic Committee and held economist positions at notable think tanks such as Bloomberg Institution and Tax Foundation. He's been cited by CNBC, Bloomberg, Fox News, Mortgage Professional Association, National Mortgage News, and Financial Times, among others. Mr. Logan holds a Master's of Science in Applied Economics from Johns Hopkins University, an MBA from Washington University in St. Louis, a certificate in trade policy from Harvard University, a Master of Music from the University of Cincinnati, and a bachelor's degree from Northwest University. He's currently a PhD candidate in economic policy and international security at the University of Maryland at College Park. David, thank you for joining us again this year. We appreciate that.
You're welcome. I really meant what I said about cutting that bio, but
No way, I like it. It just shows how your insight's going to be great. So our final candidate is Mr. Joel Kahn. Joel serves as Vice President, Deputy Chief Economist for the Mortgage Bankers Association. In this role, he's responsible for MBA's macroeconomic and housing market forecast, and he oversees the production of MBA's industry surveys, including the weekly mortgage application survey, the builder's application survey, and the mortgage credit availability index 3 of the association's high-profile surveys. Mr. Kahn presents regularly on the economy and housing market at the MBA and industry events and is interviewed and quoted frequently in national, local, and industry publications. Prior to joining the MBA, he worked at Ernst & Young's Quantitative Economic Statistics, Quest Group, and he holds a Bachelor's of Science in Economics and Statistics from the University of Michigan, Ann Arbor. Thank you for joining us, Mr. Kahn. We look forward to your insights as well. All right, well, before we get started, I'm just gonna give you a little outline of how this will work. I'm going to talk on about 3 or 4 major subjects, and I'm going to invite everybody at the end of this panel discussion, probably within 15 or 20 minutes remaining in our allotted time frame, so that you as a guest in the audience can pose questions to the panelists. We're going to hold it to the end because we may end up covering some of your questions as we go through. So you're welcome to put any questions you have in the chat box. And then if you would even like to direct it to one of the specific panelists, feel free to do that. And myself or Yana at MVBA will direct those questions to the appropriate panelists. So let's get started. I think it's safe to say that many of us in the home building industry are ready to put a fork in the 2022 housing market and declare it done and over. We were impacted by the housing trifecta, the rising inflation, rising home prices, and of course, rising interest rates, all impacted and gave us a little negative sentiment about 2022, especially coming off 2020 and 2021, which were robust years to say the least. So broadly speaking, the interest rates, the 2022 was the worst bond market since its establishment. It had never been worse than the last year. And so looking back in January 2021, our average interest rate was 2.74%. It eked up a little bit in January of 2022 to 3.45, and then it hit its peak in November at a 7.02. this, and then Freddie Mac's primary market survey, which does come out later today. Thanks, Joel, for reminding me, not till noon. I wanted to be really up to date on this. But last week it inched up from the year end and rose to 6.48. That's Freddie Mac's national primary mortgage market survey. So I'm going to start with you, Molly, first. And of course, David and Joel, you're welcome to jump in. When we saw the interest rates rise and peak in November timeframe 2022, we did see it start to soften back down and come back down towards the end of the year. So what's now? Do you expect to see the same volatility in the bond market and mortgage rates as we did in 2022? Or maybe do you see some healthy fluctuations with the up and down trading? Both the MBA and NAR are forecasting mortgage rates in 2023 to come into the mid 5% range, and Freddie Mac and Fannie Mae predict the high 6% range. So they see it coming up a little bit. Molly, let's hear what you have to say first.
Yeah, so I think, looking back at 2022, rates started off really low, and then it was clear inflation was starting to, get out of hand. So the Fed needed to start to raise rates. And there was just all this uncertainty with what was going to happen. Now, as we look at what's happening now, we look at new forecasts coming out month after month, they seem to be getting more stable. So, we could talk more about the specific, forecasts for everything in the housing market later, but things seem to be getting less worse, I guess, so I would look back at a forecast every month and I'd have to revise everything down and down and down and down, but that's kind of stopped right now. So that is really pointing to less uncertainty in the market. So that should calm the markets down, calm the bond market down, and reduce this fluctuation in mortgage rates. Now, to talk about a specific rate, I think it still points to the uncertainty that's out there. What you just mentioned, some rates are up in the high 6% range, some are down in the low to mid 5% range. So it really is hard, that also, like I said, points to the uncertainty in the market. But, we expect the rates to stay elevated from where they are now. I mean, around where they are now and not change too much over the next year. So, maybe low 6, high 5% range.
Okay. How about you, David or Joel? Do you want to chime in there?
So I'll kind of pick up where Molly left off. So I think, the way we've been digesting where rates have gone really fall into, or at least are covered by two pieces of the movement, right? So one would be just the 10-year treasury itself. So we know that, I don't know, early 2022, we were 1.5 maybe, right? We're definitely below 2 on the 10-year treasury yield. And I guess you could call it just this onslaught of upside surprises, right? Within in inflation. Well, for some of us, maybe not really that surprising, right? Sort of given what we had been seeing in 2021. But regardless, I think the magnitude to which, right, the Fed had to raise rates, right? In that sense, maybe it was a little bit surprising, right? I don't know if anyone really predicted 3 75 basis point increases. Was it 4? I forget. Yeah, I can't do the math in front of the blackboard, but you know what I mean. So we have these, this sort of massive sort of run up in sort of expectations there. So that really pushed the 10-year up. I think the bigger thing for mortgage rates was the spread between the 10-year treasury and the 30-year fix, right? Typically that's about 180 basis points, right? So if you have a 3% 10-year, you have a 4.8% mortgage rate, but we saw that spread blow out to about 300 basis points, right? So that gets you from that 4.8 to a 6 really. And yeah, that's exactly what we saw, right? When rates peaked in October, November, that spread was again 300, maybe more, depending on the rate you're looking at. And that's caused by that volatility that Molly was talking about, just the uncertainty, both from sort of a broader market standpoint, but then also from the mortgage-backed security market, right? When you have that volatility, when you have these higher rates, that impacts prepayments, right? And investors then need a much more of a premium to want to invest in MBS. We don't think that spread is going to be sustainable, 300 bips, that much, I guess, that much of an arbitrage opportunity, right, shouldn't last for too long. And I think we've already started to see that, right? If you look at the earnings reports from a lot of REITs and other investors, they're saying, look, this spread is huge. Why? There's got to be something out there we can take advantage of. I'm just speaking very loosely. So we've already started to see some of that settle. And so I think that spread is down about 250 right now on average, right? If you kind of level things out. So that's why we have rates coming down to about the low fives, 5.2 by the end of next year, because that still reflects about a 200 or so basis point spread. So it's still elevated relative to historical levels, but it's not going to be what we saw late last year. So the spread component we think is huge. We think is huge, right? Just that coming in alone is going to make up for a lot of the rate drop. So I'm going to stop there for now.
All right, well, actually, that kind of leads me into when you're talking about the yield spread between the mortgage, but we used to look at the Fed funds rate plus 2%, which would be on the average of interest rates. And so maybe, David, I'll let you talk a little bit about the 2-10-year comparison versus the 30-year. Do you want to talk about that a little bit? That's out of left field. It wasn't on my outline. So if you don't want to, I apologize.
Yeah, no, sure. So I'm not on mute, right? No, I'm not. No, that's yeah, that's perfectly fine. So I just want to mention one thing that Joel touched on. Joel touched on the MBS market and how that plays into everything. But I just remind the people on this call, don't really have to be reminded, but I'm always thinking about the MBS market and those investors as not just being a cause, but also showing an effect too. So there are things that we can glean about the whole market from their behavior, but it leads me to another point, which is just keeping an eye out on the stock market and equities prices writ large, whether it's the Dow, the S&P, the NASDAQ, and then also in relation to international markets. But when we're at historical lows, we see this search for yield, quote unquote, and it's been long enough since that was so overplayed that I can actually say it and not want to hit myself. But as the one thing other than housing that really took a hit from the Federal Reserve raising rates last year was the stock market, and so I look going forward for the spread between those mortgage rates and the government rates to depend on both where else can you get that similar yield. So for MBS investors, they're going to be looking at equities markets too, even if it's outside that core silo in the portfolio. But another thing that people don't frequently talk about a lot anymore is just this uncertainty of economic policy in the U.S. Regardless. So that has definite real effects on Treasury rates and the 10-year, and so what we've seen over the past 3 quarters, 4 quarters is what everyone knew we were going to get, which is Econ 101. This is one of the things that actually does play out in real life, like it does in theory, which is when you front load a stimulus, if you pack it with all demand side stimulus, which pretty much it was all demand side, you're gonna have a large drag on growth, even though you get that huge boost up front. And so we're still in that drag on growth period, and we're going to stay there. And there's nothing that anybody can do about that. So that's something else to just kind of watch out for as we move forward. That'll affect kind of the 10-year yield also. But that point about the stock market too is just one for general housing demand, because the market, we spoke before, but the best part of the market has been higher end buyers in no small part because home prices are so high. But the ability for people to cash out parts of their portfolio to use for down payments, in addition to their existing equity, fell a lot last year, and it was extremely high the year before. So we'll have to see how that bounces back. If the stock market bounces back, that's a good thing for narrowing of the spread and for ability of those higher end buyers.
Well, that's kind of a good segue into our next one of the trifecta in what impacted us in 2022, and that was inflation. And real time today, the CPI just came up, it went up 0.3. That was as it is expected for the Wall Street gurus. So it did have a pretty negative impact initially on the bond market. It seems to be, and I'm talking real live time, it bounced, went way down and then went right back up. I'm looking at my screen. So it seems to be softening out a little bit. But just to recap the previous years, we had obviously, I'm going to go back once again to January 2021 with inflation at being 1.4. And then it just completely imploded in January 2022 to 7.5%. And then September, October timeframe, it jumped up to 8.2. It did start to see some easing here. It did go up a little bit. I don't know if that's from, well, I'm not even going to guess because it's not my area of expertise. But so let's talk about the impact on this news. Inflation is still in knocking at our door. And so I guess my next question, Joel, I'll start with you. And of course, I'm going to ask you all to, but my first thing is, are the Feds going to achieve their soft landing? Do we see this economy either easing back into a normal economy, or do we see it going into, are we recession bound? And if we are recession bound, what do you think the Fed reactions will look like at that? And the third question, and they'll all tie together a little bit, is do you think we'll reach the Fed terminal rate in 2023? And if so, when and what rate, sorry, David, what rate do you think the Fed is leaning towards on this terminal rate? I'm telling you, the bond market started way down on this news, and it's back to nearly flat, which is good news for us in the mortgage industry. But I'll let you start, Joel, and then everyone can chime in after that. So.
Yeah, absolutely. So I guess I would call it a soft-ish landing, if there's such a thing, or I don't know if you could even call it soft. So our baseline forecast is for recession in the first half of 23. It's not going to be a long sort of protracted recession, right? It's a 2-quarter, really sort of so somewhat of a pull forward in growth, right? Somewhat of a let's sort of wait and see holding pattern for businesses, right? A lot of business investment generated sort of pullback. Obviously, some impact from the punch bowl has been taken away, right? For a lot of consumers as far as stimulus goes, right? People are starting to tap into savings, use more credit card debt, et cetera, which I'm sure we'll talk about later. But that generally is going to cause sort of just 2 quarters of negative growth. We think that the Fed is going to raise rates at least 2 more times in 23. I think their projections suggest, I think it was 3, right? And then not cutting rates for a while. I don't think we or markets more broadly believe them at this point, looking at what the indicators are telling us. But anyway, but we just don't see them raising a 3rd time in the middle of the year, especially if we do get the slowdown in growth that we're already starting to see. I think maybe the one thing that's playing against that is the job market, right? That's been holding up a little bit better than I would have expected. The December number still showed about 220,000 jobs added to the economy. I know that's not showing everything, but reason why I'm getting to that is, yes, we have a recession, baked in here. We know that inflation seems like it's starting to cool a little bit. I mean, if we dig into the details, again, we might spend another 5 hours here, but I think that's going to give them a little bit of ability to, to continue with smaller rate hikes for now. I think they are going to have to sort of hold at that, let's just say 5% range, right, for 2023, unless something more severe happens. But at this point, I mean, we've all been through the last 2 years together, looking at the news and the data coming in. There's certainly much more. It seems like there's much more margin for surprises, right, both to the up and the downside, whether it's a geopolitical event, right, or something else. So the short answer is, we, again, our baseline is for a recession in the first half, a shallow one. We have the funds rate just below 5 for all of 23 before the first cut, maybe in early 24, and then inflation not really getting back to their target till maybe the end of 24, right? Because it takes some time for that to happen, and you have more persistent inflationary pressures like shelter, for example, which I know we'll talk about. So I'm going to stop there.
Okay. All right. Molly or David?
Oh, sure, I'll go. Yeah, so right, agree with you, Joel. With the inflation where it is now, I mean, it seems like we really, the crisis of inflation is over. It seemed like it might get out of control, but the Fed acted, it started coming down. It's still where it is now is 2 to 3 times what they're looking for it to be. So definitely see the Fed continue to raise this year. Probably by spring, they'll hold it where they, hold it probably around, like Joel said, about 5%. And a soft landing would be great. I don't think that really happens in real life. So
Not yet.
exactly. There's first time for everything.
Right.
So, like Joel said, most likely a shallow recession, nothing like we saw, in the Great Recession. So, but and Joel did mention employment. It is one of the wild cards right now. It is still really holding up, and even with the mild recession, unemployment really only goes up to about 5%. So we don't see a huge jump in unemployment, which will be, will help the recession remain mild as people are able to keep their jobs and continue spending. And we also don't see any change in course until 2024 by the Fed, as inflation just needs to slowly get back down to near that target rate.
Okay.
Yeah, and just to add a couple things, I can see us. I could see the job market effects being highly kind of bifurcated, for lack of a better word. We've already seen kind of the difference between non-supervisory employment and quote white collar job employment. I think that I don't question whether soft or hard landing. For me, it's mostly been a question of crash versus hard landing. So I think signs point more to hard versus crash, which is obviously great. And the CPI numbers that just came out, one, I think the initial reaction that you saw was like we see with every data release. There's a lot of arbitrage happening real fast, but something that I think the Fed is not going to like, although we'll have to see how it plays out in the PCE, because that's the inflation they really are looking at, is that energy prices are what are really what tamed the headline number. So X energy, it was not great news. X energy over the past 12 months, it was still, food was up more than 10%. X food and energy over the month, it was up 0.3%, which is actually an increase from the month prior. And that to me in markets today is probably going to get the most attention. But NAHB is where Corelogic and MBA are with regard to kind of rates moving forward, where we have a couple increases in the beginning of 2023, and then leveling off under 5%, and just kind of staying there, waiting for the employment to kind of take a hit if it does. But just real quick, something I said the other day is that one worry that I do have is that the Fed is only looking at how much inflation is still going with employment, and not looking enough at why the inflation is happening and what they have in there, what they can and cannot control. So the supply chain disruptions that have been a very real cause for a lot of the price increases, those are not completely ironed out, and interest rate policy has very little to do with making those run kind of smoothly again. And so I am a little bit worried that they overshoot with the rate hikes because they think that they still have more work to do, when in fact it's kind of just the international domestic supply chain situation working itself back to some semblance of normal still, which I don't see happening till sometime in 2024.
Okay. We did touch on something we'll get to in a little bit here, about the unemployment and the wage and housing affordability and things as well. We'll get to that in just a little bit. So thank you all for that. I not that my opinion matters, but I do see us still heading towards a recession. I'm glad to hear that you think it's going to be a shallow one, because obviously our members here, they will be impacted greatly by that, and we don't want to have that. So I want to talk a little bit about the builder confidence index, the median house prices, and then the housing shortage, kind of lump them all together into one. And the builder confidence index is really has hit an all-time low. December of 2021, last year this time, the builder confidence was at 84. The index was at 84, and then it ended the year at 31%. That's a 63% drop in builder confidence. However, thankfully, it isn't in line with the median house prices, which actually rose just slightly. We went from the first quarter in 2021 to an average home price of $369,800 to 2022 at $433,000. That was a 17% increase. I'll come back to that later in a part of the discussion. And then in the end of the last data I have, Q3 of 2022 was $454,000, which was the 5% increases. Fairfax County and Virginia, very healthy housing growth here, 6.9% in 2022, and Virginia year over year was a little bit over 10%. In the last 5 years, it was 51% increase. So that's really quite significant. But couple that with, and that's probably part of the reason, we have a housing shortage. Still, the MBA, National Association of Realtors, says there's a $6.8 million deficit or shortage of housing units. And so we still have housing in short supply, which could bode well for builders because they can build the units and build the housing for people. But we did see a decrease in the housing shortage. We were at 811,000 here locally, and it dropped down to 632. So that was a drop in about 22%. With the same vein, housing starts also dropped from December 2021 to December 2022. That went down 16% from 1.7 million down to 1.4 and change million. And that's the lowest level of housing starts we've seen since the pandemic hit of March of 2020, which stands to reason. So tying together the median house prices going up and also gauging with inflation, let's face it, real estate ownership still continues to emerge as a hedge against inflation, even with, as David mentioned, the stock market. So my thought is there is a cost of waiting for the consumer. If they sit there and let interest rates dictate when they're going to move into a house, they're going to miss out in this beautiful growth, even the slower growth of 5%. So let's talk about that. We've got a huge tsunami wave of first-time home buyers coming at us, and that's the millennials. They represent 43% of the home buyers, and there's about 50 million of them, ages 28 through 38, with the average home buyer being about 32 to 34 years old. So, David, you mentioned in an article earlier that the interest rate spikes of last year priced out nearly 20 million households from the housing market in 2020. That's significant. So I guess I want to talk about how do we tie together the millennials with this housing shortage and the interest rates? How do we make the housing market a little bit more affordable for the first-time home buyers? So I will direct this question to you, Joel, first. I think, and Molly, remind me, this is a topic that's okay, right? Just
Yeah.
Okay.
Definitely.
Okay.
Yeah,
All right.
we do a lot with this.
Yes. Okay, good. So maybe I will, who wants the first crack at this affordability question? I'll give it to you, Molly.
Oh, sure. Yeah, I'll go ahead
Okay.
and start, and then I
Yes.
think we were going to talk about some specific programs.
Right.
So
Mhm.
yeah, I mean, wow, it's you go from the lowest mortgage rates on record to what I mean, I guess I don't know. We remember when mortgage rates, or I mean, I personally don't remember, but like I didn't have a mortgage in the 80s, but we look at the data, the mortgage rates were a lot higher then, but it's all where we were with the mortgage rates. So we just go from the lowest mortgage rates, we spike up over 300 basis points on mortgage rates. And the problem with that is that most of the buyers, especially the first time home buyers, are really looking at their monthly payment. And with, as you mentioned, home prices up 17% last year or whatever time period, home prices spiking, mortgage rates still really low. Borrowers were able to get in at a very low monthly payment.
Mhm.
And they're locked in there. So as they see mortgage rates go up 300 basis points, they're priced out just merely on the monthly payment. So that hits the affordability there. And then talk about, I mean, do you want to talk about supply? Because, that does feed into the mortgage rate.
Yeah, that's exactly. That goes into my housing shortage data there. So definitely talk about that.
Yeah. So, that all feeds in together. And what we're saying is, we're in a standoff here. You have the buyer, that huge wave of the younger millennials who are really at that prime age to be buying. They can't afford to buy because of prices spiking, mortgage rates spiking, and there's low supply, which does keep home prices going up. But then you have this standoff that I'm talking about, which is the current borrowers are 99% of them are locked in to their low mortgage rate. So, and then they see home prices softening a bit. So they are not going to get the 20% more that they expected this year for their homes. So they don't want to sell. So they're not, we track listings from the multiple listing service data, and, new listings are extremely low. So we started with a really tight supply, which has gotten even tighter. So that's where we're seeing the standoff that I'm talking about, that borrowers can't afford. They do hope prices are going to come down. Buyers, owners don't want to sell, so that's constricting the market even further. So yeah, it's just that's going to hold back the first-time home buyers market, which did do pretty well, really, during the pandemic, and is still actually holding up better than you would think in the current situation.
Yeah, that's a good point. I just, we are still, the housing market is still comparative. I mean, if we take out 2020 and 2021, it's still a very robust, healthy market. I mean, you're seeing a softening of appreciation, but you're not seeing a decrease in appreciation. And let's hope and pray that doesn't happen. I personally don't think it will. If you have a housing shortage, it's counterintuitive that you'd see housing prices drop unless it's not priced properly. So that kind of, I know that we'll let David and Joel talk about the Fannie Mae initiatives that are coming out, the duty to serve, increasing the affordability, and the minimum income has now increased a good 50% almost to what it was in December of 2022. That opens up the market to lower down payments. It opens up the market to lower mortgage insurance rates and lower interest rates as well for certain condominium projects. So with that, with other initiatives that Fannie and Freddie are doing, I also see sellers, builders, they are in a position to kind of alleviate a portion of this housing shortage, but in doing so, building the product that doesn't exist previously, do you see them making, a way for them to make it more affordable, making deals and closing costs? Do you see them lowering prices? Other ways that builders are compensating for the inflation, higher rates, et cetera. So Joel, David, do you want to answer that question for us?
Sure. The first thing I want to touch on is just the supply of homes. So Molly mentioned the supply being tight. I think existing is like 3.3 months or something like that. Supply. People that have been looking at the new home supply, it's been going up. So on the face, it looks very healthy. It's kind of a mirage, just as an FYI, because cancellation rates for builders have gone up so much over the past year or so. I think they're approaching 30%. So that's one thing just to kind of keep in mind. Two is that the duty to serve requirements and kind of easing of standards from like FHFA, that would matter to me a lot more if we were in a situation where we had a boatload of buyers waiting on the margins, right? If we had a bunch of people who would be able to make it if their mortgage was $200 less a month. And unfortunately, what we're seeing is even with homes priced at the very lowest end of what you're going to build right now, which is about $380,000, something like that. You're looking at buyers who are going to fall well short of that DTI threshold when it comes to underwriting. So those initiatives don't look to have as big an effect on the state of play where it currently is as interest rates come down, then relative to what it would have been, then I see that I see that as a good thing for demand, obviously. But then the other thing is at the higher end, you have to remember that millennials have a boatload of student debt. They've got more student loan debt than any other generation ever has. And FHFA, I don't know, was it 3 years ago, 2 years ago? They finally released new guidance on how kind of the underwriting system had to take into account student loan debt. And I think it's a point or something like that. It can fluctuate.
Yeah.
It can fluctuate, but
yeah, Fannie Mae still has the 1% of the outstanding balance, but both FHA and Freddie Mac dropped it to 0.5%, and then
Yeah.
VA has a whole calculation that's even less stringent. So, but
Yeah,
yeah,
so I realize that that's got a much bigger effect on the conforming market.
mhm.
But that to me is definitely something to keep in mind, looking at the cohort of buyers that are coming in concert with where do they want to live, because honestly, you don't have land to build a place unless you're going to go 30 miles outside of a core large metro.
What about vertical? I mean, that doesn't need as much land if you keep going up. Joel, what do you think about that as a way of combating some of David touched on the housing shortage, which is also commiserate with the land shortage that we are facing, especially in Northern Virginia. The builders here are going further and further out, both, all the way down. Well, I don't want to say anywhere because it's like, but it's away from that core area. So Joel, what do you think about a more compact, urban, vertical?
Yeah, I mean, I would agree that I think the bottom line is we need more supply, right? More affordable / entry level supply, because that's really what's generating, I think, a lot of the home price growth. Yes, we have, I guess, demand side assistance, right, from some of the GSE changes. So you pointed out, increasing the AMI thresholds, right, the area median income thresholds to first time home buyers, at least, right, can get to about, was it 100%? And then I think in high cost areas, 120% of
Right.
AMI.
That's right.
And then you have sort of the eliminating, I guess it's the elimination of pricing adjustments, right, for those programs, plus the Home Ready and Home Possible, which are the GSEs, sort of low down payment programs. But anyway, so yes, those are all sort of demand side, right, and those actually in some ways sort of act against what we're fighting, what we're dealing with, right, and that's the supply shortage, right. So yes, I mean, I think higher density certainly will help, especially, in areas like, you could argue Northern Virginia, for example, right? I mean, I'm in Fairfax, and people still wouldn't really mind sort of a 2 to 4 unit, right, development, because it's still, I don't know, it's a good mix of urban and suburban, I guess, put it that way. I don't know, maybe it's my own bias, because I'm a mile from Wegmans and I can walk to places. So anyway, the entry level supply is a big deal, because I think we've been underbuilt the last decade. I mean, we've talked about this already, and I think more so in the one single unit space, right? I think, correct me if I'm wrong, I think the 2 to 4 has been okay, 5+ has been okay, but I think mostly in the 1 unit segment of the market, and so, if and when we can get more of these units, again, whether it's condos, whether it's apartments, I mean, that certainly helps. I mean, without getting into too dangerous territory, I mean, I think the GSE lending for condos has been a little bit less friendly over the last year or two when it comes to, HOA requirements, the questionnaires, et cetera. Again, I'm not going to touch that to a great degree, but definitely that hasn't made it easier. And that's typically been a pretty good entry point for a lot of first-time home buyers, right? Buying a condo or a walk-up, whatever. And then I would actually, before I forget, I wanted to make a point, or at least follow up on a point Molly made about sort of the lock-in effect. I mean, the way I've been thinking about it too is that you have not just sort of yes, we have lots of people locked in because they have low mortgage rates. They bought when prices were high. But I think if you think about the need for move-up units, or at least not just the need for move-up units, but then also vacating the entry-level units, right? People are holding on to condos and townhouses with a 3% mortgage rate because they can rent those out, because rental rates are still running at a pretty decent clip, right? So you're not only giving up that low mortgage rate, you're giving up a potential rental property. And we know that lots of what we have now in the rental stock are mostly mom and pop, right, individual investors. So that's continuing. Obviously, it's good for those folks, but at the same time, right, that's locking in a lot of these lower price units. So one other sort of data point I'd throw in there is I think David has some great data on sort of the pricing out effect of the increase in mortgage rates. We track the median purchase mortgage payment, right, on a new mortgage, and that's gone up about 43% between over the last 12 months, right? So we were at about $1,300 a year ago. Now it's about $2,000. Again, the median purchase payment for a new mortgage. Again, 43% increase. And the reason why I'm mentioning that is because even with rates coming down to the 5% range, and even with home prices getting nationally some, small negatives, right, in the next 2 years, that's only going to come down about 25%, right, if the forecast holds true, right? So that's good, but it's only a dent, I think, right, in the affordability question. So yes, mortgage rates will help, right? Home price growth moderation will help, but I think we need a little bit more there when it comes to supply to bring some of those I guess unit prices down. When especially when you're talking about first-time home buyers.
Right.
And Carol, sorry, just from our perspective, NAHB, when we've talked with the White House a good deal lately on the affordable issue, like the affordability issue, and I think Rob, I know Rob agrees that the biggest thing holding supply back in the grand scheme of things is just really tight zoning requirements everywhere. And zoning, you talk about building denser, there are lots of places that are increasingly fighting higher density. And that's in addition, we've already seen what zoning against that has done. I mean, that's what made California the market it is on the coast, right? There's this Econ 101 example of San Francisco not being, you weren't allowed to build in front of someone's view of the ocean, which is still in place. And so if we could get to kind of a more friendly zoning environment, that to us would go a long way. But the federal government has no say in that, nor on a personal level do I think they should. But it makes it much harder on a national scale because it's so heterogeneous among localities.
Yeah, and I think we got that playing out here in Northern Virginia right now,
Right.
with the Arlington fight. That's where I'm sitting right now, and it's pretty bitter. You just walk around and 90% of the yards have a sign saying the world's going to come to an end if we get a townhouse across the street.
Not
Personally,
in my front yard.
yeah, personally, I've got a vacant single family across the street from me that's falling apart. So I really wouldn't mind there being, a much nicer looking set of higher density. A little bit higher density if it was actually maintained. So yeah, you've got a bitter fight here, but it'll play out this year, and I'm sure some compromise will happen there, and we will end up with some higher density in this area. So that should help, but definitely watch what's happening this year in this area.
Yeah. I think that's true. About the density, especially there's some questions coming in about, as you said, Molly, there is a fight in your neighborhood. I heard mentioned on the board meeting the other day, some of the PACs were also fighting in Fairfax County. So I'm sure we're going to get more questions about that. So I guess, we've got about 6 to 15 minutes left to talk about before we open it up to some questions here. We were talking about, we touched on the inflation numbers. Joel brought that up. The inflation numbers, there was growth. It was, not as robust, but it was primarily leisure and hospitality, ambulatory healthcare, and construction. Not so much wage growth. So basically we're touching back on this affordability issue where our wages keeping up with inflation and interest rates. I think we all think the answer is no. David, you mentioned something about, we touched on being priced out of the housing market, but there was another data point you mentioned the other day about you thought the entry level houses were gone, right? Didn't you mention something about that?
Yeah, I mentioned that when asked by reporters about the the entry level market, kind of I flippantly but seriously you know frequently respond that that market is all but gone, as we traditionally think about it. So and that's what you're seeing in those priced out numbers that Joel mentioned, and the priced out numbers that NAHB releases every year. You're and also in the quarterly release on sales, you can definitely see it when it's broken down by price, where those sales are going. And on the low end, they've on the distribution, they've gone from making up 20% to making up 5%, depending on how you define the entry market. But regardless of how you do define it, that part of the market has basically squeezed down to the point where you need a very generous relative, and a good job, and a decent amount of savings to get in. But because that down payment, without a sizable down payment, you're not going to get your monthly payment to a point that anyone will approve it.
Right. There are some things out in the market. Freddie Mac has kind of like a crowd sharing gift program that you can sign up for that's helping.
Yep.
It's kind of an interesting program. Obviously gift funds are, I mean, unfortunately, it can be a very disparative type of the haves and the haves not, because
Yeah, it's that
like,
I mean, it goes a little bit, it's the same bifurcated market that I kind of mentioned with the job market earlier.
Right,
but yeah, that's and I'm sure you all love dealing with those gift letters and everything that goes into making sure that those are squared away.
exactly. Well, we're going to wrap it up before we start entertaining questions. And I'm trying to, 2022 was not, it's hard for me to sit here and tell everyone it was not a bad year. Actually, if you look statistically at the numbers, I know that when you do the comparison to 2020 or 2021, it was just in the doldrums, going nowhere, doom and gloom. But I'm hoping to end this before we open up into discussion with some good news. I do feel like the housing market is starting to gain some momentum right now. A couple of people mentioned in a board meeting that the spring market is starting, which means that they're getting some traffic. And I think that's hopeful. That could be on the basis that we all get acclimated to an interest rate. We all got acclimated to the 2s and the 3s, and then went through a little bit of a shock and awe period in the second quarter, third quarter of 2022. But now things have stabilized a little bit. And I would like to hear, and I know no one has a crystal ball, but let's hear some good news about 2023. I'll start with you, David, then I'll go to Joel, and then finish with Molly, and we'll go in and answer some of these questions here.
Well, I think the best news going into 2023 is that the worst in terms of all the nominal headline numbers that we keep saying, the worst is seemingly behind us. And I could basically stop right there and be like, all right, have a great day, everyone. But I'm serious. We've talked about inflation, the highest year-over-year inflation rates, those are behind us. The highest year-over-year producer price index. Well, this released this morning, by the way. Next week's producer price index is going to get a lot more scrutiny than it usually does. So we'll wait to see what those prices do. But we're past the high point of those year-on-year changes. We've seen mortgage rates come down. All of us, here expect them to level off / come down further, barring some other huge, significantly negative event. So, and then add on top of that, that we were in this period of huge volatility, and that also seems to be in the rear view mirror. That volatility in large part was increased by the uncertainty in the economic environment, and that uncertainty has been mitigated substantially. And so as kind of the environment gets more certain, regardless of what levels that you're at, that is a much more healthy economic and investment environment for the macroeconomy than we've had over the past year. And so that to me is a good thing moving forward, especially, there was talk of the wage price spiral, for instance, and depending on which metro you're in, you could argue that definitely did happen. But what we're seeing with wages now too is that wages are not pushing up that inflation in that kind of death spiral fashion. So those are all good things for me as we look forward to 2023. And our chief economist Rob Dietz, he sent out an email last night, just said that that we're already starting to see signs of this cooled market kind of turning, and expect to see a seller market kind of come back into the fold in the middle of the year.
Well, that's good news. How about you, Joel? What's your prediction and crystal ball good news for 2023?
Well, want to start with sort of a personal experience tale. It just this past weekend, my wife and I went to an open house in Vienna for my in-laws, really not for us, but it was packed. It was, there were about 40 people coming through, and apparently there are already 5 offers on the house.
Nice.
Obviously that's one house in one neighborhood, right? But I think the point is that a lot of us get caught up in the national numbers, right? Being sort of from a macro view, but I think some markets are going to come out of this a lot faster, right? We're seeing it. Obviously, this area tends to be more robust in general, right? The highs might not be as high, the lows might not be as low. So we're certainly, I'm hoping that's that's one step in the right direction, what I saw. But thinking about the sort of the home price forecast and the rate forecast, right? Rates, yes, are pretty universal, but the home price forecast, we have small negatives. Some places are going to see bigger declines than others, but in many cases, that's kind of a reversion to what we're sort of used to seeing, right? I think the 2020, 2021 numbers were the anomaly, and I think that's good news. Obviously, there are going to be people who are underwater, not good news for them, but I think from sort of an opportunity standpoint, right, from this demand that we're getting, again, we have the 50 million potential first-time home buyers. Even if we get a slight, sort of a shallow recession, I think for the most part, in the aggregate, you're going to have pretty strong housing demand going forward. So, we think those are a lot of the bright points for 23. And yes, you look at our forecast, the 2023 totals are sort of the low point, right, in the horizon, but I think it's really sort of the beginning of the next phase, right, where we're going to see growth in 24, 25, right, as you have, hopefully, right, the macroeconomy stabilize, right, people will get used to the 4.5%, 5% mortgage rates, because we all know when someone has to move, they have to move, right? So whether they're moving across state lines for a job, or whether they need to sort of get a bigger house because of a family or a multi-generational house, et cetera, that's going to happen, right? That's going to, and these changes, I guess, lower rates, more stable home price growth, that's going to help all these things sort of fall into place. Again, freeing up some more inventory, right, and giving these first-time home buyers more opportunities. So that's, again, we could talk all day about that, but that's sort of my short answer for now.
Well, I like that. And then Molly, I'll let you finish and then we'll wrap up. And there's just a question or two here.
Yeah,
So-
sure. So, you know, one thing we didn't touch on is one of the benefits of all the home price increases over the past, I mean, really 10 years, home prices been going up, is the huge amounts of home equity that borrowers are sitting on. So number one, that means they're well positioned to weather this recession. Even mild recessions are challenging. So, you know, borrowers, homeowners with mortgages are well positioned for that. We're not going to see a return to, you know, the Great Recession spikes in negative equity. You know, as a fun fact here, we estimate that home prices would have to fall about 40% to hit that amount of negative equity. That's just not going to happen. I haven't seen, even the worst forecasts aren't even close to that. We have home prices, you know, dipping negative a little bit early this year. And then, but average for the year about a 2% increase. So that's another positive thing. And then, you know, the huge amount of home equity will help fuel, you know, move up buyers with their down payments, number one, and then also remodeling and reconstruction. So, you know, just in a home, you know, homeowners are in a really good position right now. So if you do get those move up buyers, that should free up some of that entry level units as well. Yeah, exactly.
Yeah, and can I just throw in one point? Thank you, Molly. The MBA's delinquency survey showing delinquency rates are at actually historical lows going back to 1979 right now. So that coupled with the home equity piece means we're not likely going to see this rush or foreclosures or distressed sales, right? And so that's going to help, I think, again, weather that storm. So that was a really good point to make. Thank you.
And I'm sorry, can I just add real fast? Along with, you know, the move up buyer, you know, that I think borrowers are holding like 30 trillion in home equity right now or something. You know, we talk about the ladder of home ownership and that churn that we like to see, and the bottom rung of that ladder just not being active, but you need that churn for it to be active. The other part of the market that that is good, kind of points to a better 2023 and beyond, is that downsizing part of the market, right? We still have a lot of boomers who are going to downsize, who haven't done so already, and that's a good group of buyers. And I don't have exact numbers on the equity they have in their homes and the average you know, home price for a downsizing, but needless to say, it's a lot less than what their current home is probably worth. And so that, at least on the flip side of the entry level, helps free up room for that churn to continue.
Very good. Well, I think this has all been very enlightening, and also I have a lot of hope. I do always believe that housing is your best investment. I think everyone in this industry does, especially when you're in an inflationary market. There is a cost of waiting. If you wait for that interest rate to drop, then you're missing out on the appreciation we just saw, even in this incredibly increasing interest rate markets. So everyone I think I talk to now is coming in, they're looking at adjustable rates. That's another aspect of affordability. They're looking at buy downs. That again is getting them in at an entry level. And again, some of these GSEs have put forth some other stuff, whether that's going to resolve the the interest rate doubling in 2022, no, but it'll probably have a nice little softening. And let's face it, if you put the money in a house, you're going to get a better rate of return than you're going to get in your savings account. And that's been true for the last 5, 10, 20, 30 years, with the exception 2008 in there. So I feel hopeful about 2023. I hope builders can take away and feel hopeful too, because as I said, there's a housing shortage. They can't get to it. And we have the millennials coming in. We have new houses being formed. David mentioned on people moving down. There's a lot of active adult communities being built by builders now that are addressing that. Not so great for the mortgage industry, because most of these people are coming from a big fat house and then buying another house and using mostly cash. But as long as we can still generate some housing in this market, I'll be happy with that.
Yeah, we
So
just need the units. It's okay.
yeah, we need the units, exactly. So we have about 15 minutes left, and I do have a few questions from the audience, and we'll go back to the zoning and the anti-government builder kind of topic we addressed briefly, and from an anonymous attendee, because he's probably a builder, but with the change in the Fairfax County permit system, and I'll read the question now, with the change in the Fairfax County permit system, some 5,000 permits are backed up right now, and the county officials are telling people to resubmit their permits months after submitting them in the first time. This incompetency, combined with the heightening zoning regulations, is squeezing builders. When is government going to be a partner and get out of the way? I think that's true with every industry, but I'll let somebody answer that question. Who wants to do that?
I'll take it, just because I've talked to this person, or a version of you
Okay.
hundreds of times at events from our membership. And the answer is, when was the government a partner to begin with? The answer is not really ever. But getting out of the way is something that we've not really seen a whole lot of in the past, in terms of zoning and being more builder friendly. But at least on the government relations side, that is something that the government seems to be more keen to engage on now than they have at any point that I remember in the past. So, that is a good thing, whether it's all just lip service and BS or not. Time will tell, but at a certain point, the supply-demand imbalance will force your hand. You're gonna have to do something. So get out of the way, get pushed out of the way, one way or another. Eventually, they're gonna need to help in some point, because if not, the leaders of those governments that are in charge of those regulations, they're gonna see people moving away, and they'll see net negative migration, and their local economies will suffer. And home building is a major driver of the macroeconomy and local economies too. So that's my I'm called an ad hoc government affairs employee. So that's me with my government affairs hat on.
Okay. All right, Joel or Molly, you want to end it with that? Okay. We have another question. It's a two-part question from Kate McCloskey, and she's asking, do you see more builders considering build to rent products, and are the larger national builders or smaller regional builders suffering more with existing economic conditions? Joel or Molly, I'll let you answer that question.
Yeah, so I don't know. I mean, maybe the others have information on build for rent, because I'd love to hear that. But you keep talking about housing as an investment and inflationary hedge. Yeah, I mean, the home prices have gone up, but rents have done the exact same thing.
Mhm.
So they've they don't go up as much as home prices, but rents have been increasing 10-15% for the past year. So there really is a need for more rental housing as well. That goes to, you have buyers who can't afford to buy being displaced into the single family rental market, especially. And then you have the shortage of rentals in general. So as you do have that need, build for rent. I don't know how economically feasible it is, but I could see a need for that. I don't know if David or Joel has any like numbers on build for rent.
Build for rent, so it is still a much smaller part of the market than you would think when you like open the newspaper, because it's gotten so much talk over the past year or so. But it's a small portion, but it is a growing portion. So yes, we have talked to a lot of builders who are proactively asking questions on, how do we get into this space? Is it financially feasible? Where does it pencil out versus where does it not? And then, there are two types of build for rent. One's included in the census data, one's not. But there's built for rent where a developer builder they literally build for a larger buyer who's contracted in and going to rent out those homes. And then you have the investor pool, the people that come in and buy individual properties within and then turn those into rental. And so there's been a little bit lately of the build for rent getting squeezed as actually rents go. Rents keep going up, or they need to go up even more given interest rates and the cost of building. And that is kind of a segue into the large versus small. If you have access to capital markets, you're going to be doing better in bad economic times than someone that doesn't have access to capital markets. That's an overgeneralization, I know, but the largest builders, they do have access to private equity, private borrowing that can issue those senior notes. Most builders cannot, and so they will hurt more when there are problems with materials price appreciation, lack of buyers, etc., because their cash flow is just simply not near what cash flow of the larger builders is.
Okay.
And I guess this is maybe a comment / question. What we were hearing from at least some of the mortgage affiliates of builders were that the larger publicly traded builders tend to have more negotiating power, right? And a lot of the contracts that have been in place have somewhat protected them from some of the price shocks for the most part. And then obviously there's land options as well. So to your point, they might be a little bit more insulated from at least some of the nearer term shocks. Is that the way to characterize it, or the way to think about it?
Yeah, I think so.
Yeah.
Little deeper pockets get you through the rougher times, so. All right, well, I think that's it. Unless anyone has anything else to add, I'll bring Debbie and Yana back on if you're still there, and we'll go ahead and there we are, and we'll wrap up with your final things. I'd like to thank everyone for joining us, the panelists especially. Your insight and expertise is so appreciated. Every time I do this, I learn something new and more, and for the most part, I feel like I can take this knowledge out to my clients and say, it's not so bad, let's sell more houses. Let's do, what can we do? And I'm hope that this is a trend in the positive for the next couple of years, and we get back to a nice, strong real estate market, which Northern Virginia has always enjoyed. So Debbie, I'm going to turn that over to you now.
I will only take a minute of your time, really. I want to thank you, Carol, for putting the program together, and Molly and David. And Joel, thank you so much for your insightful information that you were able to impart today. NVBIA, like every builder in the area, watches all of these numbers and watches what's happening across our region very closely, as well as across the US. So we are cautiously optimistic all the time. We have to be. But I know that what will happen during 23 and 24. I've been in this market on a builder side and an associate side for a long time, as you can tell. So I've seen a lot of ups and downs in the market. What comes up must come down, and what's down always goes up. So there's my last parting thoughts, and thank you very much, everyone.
All right, thank you. Okay.
Thank you.
All
Thank
right,
you all.
you're welcome. Bye-bye.